Welcome back. You're watching The Money Show on ET Now. And if you've been tracking gold prices of late, I'm sure you are a little worried, seeing that every Indian household has gold lying with them. Gold prices have plummeted to 46,000 rupees. And I say plummeted because it was just 6 months ago we were talking about how gold is at 56,000 rupees. So it's a 10,000 rupee dip in the last 6 months itself, almost a 4,000 rupee dip in this year itself. So is this something that you should be worried about, or is this an opportunity, especially for those individuals who don't have financial gold that you have invested in for financial purposes with you in your portfolio? So to talk about this, we have with us Anil Rego, founder and CEO of Right Horizons. Mr. Rego, thank you so much for taking our time to join us on the show today. So let's talk about that. I mean, how do you view this fall in gold? Is this something that should worry investors, or do you think they should see this as an opportunity to perhaps buy gold at not a very exorbitant rate that it was commanding a few months ago?
Yeah, so all asset classes actually have their market cycles, and gold also has seen a bit of a negative correction this time, and a good reason for it is U.S. Treasury yields have been going up, and gold has sort of a negative correlation to U.S. Treasury yields. The second part of it is thanks to COVID, gold had seen a very good spike. It was one of the best performing assets of last year. And so when things start normalizing a little bit, when vaccinations start, you see the infection numbers in the US sort of start going downwards. Actually, investors get a little more complacent, and they are willing to take more risk. And I guess a combination of these factors is leading to the current correction in gold. So I think it's not too much of a cause for worry, okay, but we ourselves gave a muted view after the very good performance in gold for 2020 in our annual review. We suggested that gold may be muted, so it's, I think, just a normal market cycle.
Well, you suggested, you foresaw that gold will be muted, and it looks like muted it is for at least so far this year in 2021. But Mr. Rego, what I want to understand is that how should one view gold in their portfolio? I mean, on one side you have all the jewelry, the ancestral jewelry that is there in almost every Indian household. But then on the other hand, we often say gold is a good hedge for your portfolio because when equities fall, gold rises, so on and so forth. So if that is the case, isn't this a good time then to be buying gold?
Yeah, so the way I look at it, you need to differentiate between gold as an investment and gold as jewelry, right? So I guess the ladies will not let you sell it, so but it's a good asset for the long term. On the other hand, gold as an investment, yes, it plays an important role, especially if you are equity heavy, okay, because gold does have a negative correlation again with equity markets, and we saw that in the COVID fall, gold really spiked up, and even in 2008, the global financial crisis, you found gold actually do well, in periods of crisis. So gold actually sort of is a very good hedge in such times, because if you look at it in your overall asset allocation, when markets fall sharply, debt may not help you too much in the short run because the returns are low. Gold at such times can actually give you large positive returns to sort of compensate it. So this sort of factor ensures that if you have gold as a combination of equity in your portfolio, it'll probably be better. The performance of the both together will be better than just holding equity on its own, as interesting as it may sound. Okay, but that's how it is. So it's good for us to have a combination of gold as well in your portfolio. Maybe something like 5 to 10% of your portfolio is what you can actually look at as gold in your asset allocation.
All right. And one should not necessarily look at gold as a return generating asset then, Mr. Rego, because I'm sure that's the expectation. Last year, when gold prices went so high, we saw ETF inflows surge dramatically. That was in fact the only mutual fund category which saw inflows, which clearly I think reflects that people are thinking that, okay, you know what, maybe I'll be able to make money from gold because, you know, it's going so high. So, you know, should it not be looked as a return generating asset? Is that not its role?
See, at times, like what you saw last year, it was a very good returning asset. So there are periods when each asset does well, and from that perspective, you need to have a combination of both. And there could be periods when gold is really strong. So if you are able to get the cycles right in gold, it can be an interesting investment as well. But if you look at from a longer term perspective across a few decades or even longer than that, you will find that gold returns typically are not the best performing class. So from an investment standpoint, it may not be the best. But the beauty of it is, yes, it is actually a hedge against volatility. So that is something which I think investors should look at. But I think you cannot write it off. When it does well, it really moves. And if you see that last 2-3 years, gold has actually consistently done very, very well. So it's, I think one way to look at it possibly is to look at a slightly contrarian way. And when you find equity is doing better, and like is the case has been the case right now, maybe gold takes a bit of a breather, and that's when when equities begin to do well, you can sort of take some money out and so possibly put back in, and for which I think ETFs are one of the best way of investing in gold for the short term, or even at least be able to both enter and exit sort of based on market cycles.
Well, there are many ways to invest in gold actually, and the questions and queries we've got from our viewers are actually on those ways itself. So let's take on board our first question from Nayan Gandhi. Mr. Rego, he asks, how beneficial are the government's sovereign gold bond schemes? What is the return we will get on maturity? Is it linked to the rate of gold when the term is over? Yeah, that's I think what his question is essentially. So yeah, a fair question, Mr. Rego, asked by Nayan. What does an investor in the sovereign gold bond scheme get at the end of the 8 years? That's the maturity of the bond.
Yes, so the sovereign gold bond scheme basically is a government guaranteed bond which is linked to the market price of gold. Since there are reasonable gold reserves that we have in India, I think it's not a bad idea. Rather than import gold, have the sovereign gold bonds in order to be able to monetize it. And for the government, since anyway there is a back-to-back holding, and for the RBI back-to-back holding in gold, the price volatility may not impact them much. So, so it actually has a 2.5% coupon and has an 8-year period. Okay, so it's effectively you can invest in each of these gold bonds, and it has a 2.5% coupon, which normally an ETF will not give you. So this is an additional return that you get. Now the interest of course is taxable. The other benefit that you have for investing in sovereign gold bonds is that at the end of the tenure, the capital gains is actually tax free. So that's a very interesting one if somebody is looking at it. So when do you look at the sovereign gold bond scheme is when you actually have a need, like let's say your child's marriage, and you want to plan for it with some jewelry. It's too early to actually go and buy it. Okay, and so this can be a interesting way of actually investing, and you're not intending to trade it or look at it versus equity markets, etc. So then the sovereign gold bond scheme is very good. Yeah, just keep in mind that the lock-in is there. There is basically a 5-year lock-in. After which you can exit it on the interest date. So it's not as easy to exit, and also there is it's listed but not as liquid. Yeah.
All right. Okay. So I think the best part of Mr. Anil Rego's answer also is that he mentioned the suitability of the SGB. So you want to save for marriage, which for maybe your 15 or 20-year-old kid, then this is a good product, because 8 years later is the maturity. So it's a good saving as well, a good instrument to save the money as well. Okay, we have Shankar Dev asking us, I have a confusion about gold ETF and SGB. How can we sell the SGB after the 5-year time frame? The total maturity is 8 years. So who is going to be buying my sovereign gold bond scheme after that? Okay, so basically, I think he's confusing this with ETFs, the SGB. He essentially wants to know how will he liquidate the sovereign gold bond after 8 years, Mr. Raghu.
So there are two parts to it. One is where you on maturity, right? So that's the simplest one. At the end of 8 years, you get your money back. The second is, of course, if you want to do it premature redemption, which means you go back and actually ask for an exit itself, and this you can do at every coupon date after the 5th year. Okay. However, you need to put in your exit to the bank or post office or stock holding corporation 30 days before the coupon date, so that you will be able to get it on your coupon date. So this is a bit of a restriction that is there. However, there is actually another way to exit it, and which is also on the exchange. Okay, so the sovereign gold bonds are also traded on the exchange after 2 weeks, okay, of issuance. So you can actually go and trade it on the exchange and sell it on the exchange. Of course, the issue that you have today is the liquidity of it is not very good on the exchange. So you may not be able to get a good price because you don't have buyers for it, and if you are really in a hurry to sell it, then you may be forced to exit it in a hurry and at a little bit of a lower price, because it depends on the counterparty who is willing to buy it from you and at what price. So since it's on the exchange, you don't have to bother who's buying it from you, but the buyers will show up. Now each ISIN, okay, which means each issuance would have a separate ISIN, and each of them will be traded. So that is something that you could also do, but I would say don't count on it too much, because the liquidity as of now is not very high, and there are so many of these schemes, so it becomes a little difficult to actually exit it too easily. So I would think that the ETF on that count really trumps the sovereign gold bond scheme, because it is good volume is there, and you will actually be able to exit it most of the time at a reasonably market rate of the particular ETF.
All right. Well, Mr. Raghu, thank you so much then for joining us, with, I think, what would be deemed as a very important topic for a lot of our viewers, especially post this rapid fall in gold. But on that note, we are completely out of time, so we'll have to wrap it up on this episode of The Money Show. Thank you for watching.